After decades of saving, there is a specific kind of relief that sets in when your retirement statement arrives in the mail and shows a massive balance. You look at that top-line number, say $800,000, and assume that represents your actual spendable wealth. But there is a catch tied directly to how those funds were saved. Standard 401k and IRA contributions are made with pre-tax dollars. That means you got a tax break years ago during your working life, deferring the bill to a later date. Because of that upfront break, this chart reveals a harsher reality. The IRS technically co-owns a percentage of your account. They are simply waiting to collect their share at ordinary income rates the moment you make a withdrawal. The exact size of the government slice isn't fixed. It fluctuates depending on your tax bracket at the exact moment you pull the money out. If you take out too much at the wrong time, that tax slice grows rapidly. Failing to plan exactly when the IRS takes its cut shrinks your overall nest egg and hands over control of your financial future. The government does not let you defer paying taxes indefinitely. Eventually, the IRS puts a hard limit on your ability to shield that money. This timeline illustrates exactly when that happens. Starting at age 73, current law triggers what are called required minimum distributions, or RMDs. The IRS forces you to withdraw a specific calculated percentage of your pre-tax money every single year. You have to take these distributions and add them to your taxable income for the year, regardless of whether you actually need the cash to pay your bills. Ignoring this rule carries a severe penalty. If you fail to take the full RMD amount, the IRS levies a 25% excise tax on the exact shortfall that should have been withdrawn. RMDs act as the first falling domino in a complex chain. They strip away your control over your own tax bracket by turning a voluntary financial decision into a forced taxable event. That forced taxable event quickly threatens another critical asset. Many retirees assume their monthly Social Security checks are completely immune to taxes. The IRS relies on a metric called combined income, which we can track on this thermometer diagram. It adds up your adjusted gross income, half of your Social Security, and non-taxable interest. For married couples, crossing $32,000 or $25,000 for single filers trips the alarm. Watch the chain reaction. When forced RMDs are stacked on top, they push the mercury past those critical thresholds. Instantly, up to 85% of your Social Security becomes taxable. Planners call this the Social Security tax torpedo. It is a compounding effect where withdrawing a single dollar from a pre-tax account costs more than $1, actively penalizing other income sources. An unmanaged pre-tax withdrawal strategy costs you heavy ordinary income tax while simultaneously cannibalizing your guaranteed retirement income streams. You can interrupt this cascade. Roth accounts act as the ultimate circuit breaker because they possess two specific advantages. Qualified withdrawals are 100% tax-free, and they carry zero required minimum distributions. You access these advantages through a Roth conversion. This involves voluntarily moving money from a pre-tax account into a Roth IRA, intentionally choosing to pay the income taxes right now instead of waiting for the IRS to force your hand later. Timing is everything. Looking at this side-by-side comparison, executing conversions during your lower income years, typically right after you stop working but before RMDs and Social Security kick in, allows you to lock in a lower tax rate through a series of smaller, controlled payments. Strategically timing these conversions diffuses the tax torpedo and protects the longevity of your retirement wealth. Managing this tax cascade requires withdrawal sequencing. This is the highly calculated order in which you pull cash from your pre-tax, Roth, and taxable brokerage accounts to keep your effective tax rate as close to zero as possible. Balancing required distributions against Social Security thresholds, Medicare premiums, and state taxes requires deep analysis. It is far too complex for a standard do-it-yourself retirement spreadsheet. Coordinating these overlapping financial rules requires technical expertise. Jason Stoles and a fiduciary team at Diversified Insurance Brokers specialize in building these exact strategies for people approaching retirement. Drawing on over 40 years of experience and direct access to more than 100 carriers, they evaluate your entire financial picture to construct a customized, tax-efficient plan that coordinates every single income source. Stop letting the IRS dictate your retirement lifestyle. Contact Diversified Insurance Brokers today for your custom retirement income tax review and take back control of your wealth.